Welcome back. Thank you for being with us. And we're going to start our program now. So if we can have gentle clinking of forks, but thank you. Oh, that's perfect. There's no one to kiss, but so thank you all for being here. We've had a great morning. We're going to have a terrific afternoon. I'm really excited to hear our next keynote speaker. But first, we're going to have Abigail Suarez from JPMorgan Chase join us, say a few words. And I just want to say that, JPMorgan Chase has really been there for us so consistently. You've been incredible partners. I always say that your intellectual capital is more important than your monetary capital, but I don't say it to you. And but it's the thought that matters. So anyway, thank you all, and Abigail Suarez.
Thank you. And actually, some of our intellectual capitals at the table, so I hope you take a look at it. Good afternoon, everyone. I'm Abigail Suarez, Head of Neighborhood Development for JPMorgan Chase, and I am so thrilled to be here. I've been looking forward to this conference as an opportunity to listen, learn, and dialogue about the affordable housing challenges our nation is facing. But I'm also really excited about the tangible actions and solutions we can advance together. Before I introduce our esteemed guests, I want to share a little bit about JPMorgan Chase's commitment to improving housing affordability. We believe economic opportunity is rooted in neighborhood conditions, and supporting local communities by making housing more affordable and by making housing more affordable and more accessible is critical to a thriving economy. That is why, since 2021, we've deployed more than $265 million to more than 200 organizations, many of which I see in this room, that are working across the country. Oh, thank you. Many of which are working across the country to improve housing affordability for their communities. This work has helped create more than 4,000 affordable housing units. And not only are we tackling the housing crisis with our philanthropic efforts, we're also advising business and policy solutions. Let me give you an example. In October, our Policy Center used the firm's insights and data to release a brief on heirs property, a pressing issue that it threatens generational wealth, especially for households of color. We released these policy recommendations along with a grant to Howard University right here in DC to create a legal clinic to help local residents dealing with heirs property. Director Thompson attended our kickoff event along with our CEO of Home Lending, Mark O'Donovan, and they had a similar fireside chat and a wonderful conversation around heirs property and the various ways we can address it. This type of multi-pronged approach across philanthropy, business, and policy is critical to addressing the barriers to housing affordability. By advocating for consistent collaboration between business, government, and community leaders, we can work towards creating a more affordable and equitable housing solutions for communities across the nation. And with that, I would like to formally introduce Director Sandra Thompson and Steve O'Connor. Director Thompson, there she is. Yeah, come on up. Director Thompson was nominated by President Biden and sworn in as a director of the Federal Housing Finance Agency in June of 2022. She has over 40 years of private and public sector finance experience. Before this role, she served as the Deputy Director of the Division of Housing Mission and Goals. Steve O'Connor is NHC's board chair and senior vice president for affordable housing initiatives at the Mortgage Bankers Association. Steve leads MBA's efforts to find new solutions to affordability challenges for homeownership and rental housing. He is the architect of MBA's Place-Based Convergence Initiative, a cross-sector collaborative impact coalition focused on increasing minority homeownership in Memphis, Columbus, and Philadelphia. Convergence works to design innovative approaches and best practices that can be utilized in communities nationwide. Thank you, and please help me welcome Director Thompson and Steve O'Connor.
Abby, thank you very much, and thank you for your support of the NHC event today and for NHC in general. So Director Thompson, thank you very much for being here. We're delighted to have you on stage. So the first question I want to start with is LLPAs, unlivable price adjustments, right? A lot of controversy, a lot of opinions when those were rolled out. You guys kind of hit the pause button, decided to go back and take a little more of a comprehensive look at that, in terms of capital, market risk, et cetera. Could you tell us kind of where you are in your thought process and what we might expect in terms of future policy making in this area?
Sure. So first, let me thank you for the opportunity to be here today. And when Abigail was reading my bio a little bit, she mentioned 40 years, and it's really important for me to acknowledge my very first boss in government, Ken Bacon, who I ran into. We worked together at the RTC on the first securitization program, issuing bonds from assets that had been part of the savings and loan crisis, so it's been a while. So with regard to the four-letter word that you mentioned earlier, LLPAs, certainly one thing I'd like to say is FHFA is undertaking a pricing review. We started making changes to prices last year in January 2022, that we increased the upfront pricing for second and vacation homes and also loans with high loan limits like the super conforming loans. And so we also, in October of that same year, decreased the pricing for loans, first-time home buyers, many of the duty-to-serve loans, loans that were based on low to moderate income and AMIs across the country. And so we've been making adjustments. In January of this year, we recalibrated the pricing to correspond with the capital rule that had just been implemented. And when we think about pricing, we think, there are three components here. There's capital, there's returns, and that certainly impacts pricing. So you can't think of those variables independently. They work together. And as you know, the capital rule was changed and implemented in 2021, and the cost of capital is a little bit higher than it was prior to the capital rule. So we calibrated the changes that we've been making over the past few years and incorporated the cost of capital and also the returns that we set for the enterprises. And certainly that resulted in a lot of people not understanding the fact that the higher LTV mortgages, if you've got a loan that's 80% or higher in an LTV, the enterprises cannot purchase those loans unless they have mortgage insurance. And so we took out, we have risk-based pricing, but if you add the cost of mortgage insurance to mortgages with loan-to-value ratios of 80% and above, certainly you can see it very clearly. So I think there was a fundamental misunderstanding of how the mortgage market works, number one. Number two, those changes were implemented in May of this year, as stated. And what we did was, again, we issued a request for input on our process. We explained kind of the correlation between the three legs of the stool, and we got lots of comments, and we're in the process of formulating those comments and putting together just a comprehensive understanding of the support that we receive for the way that the enterprises price loans.
Yeah, there was a lot of commentary on the issue when we rolled out. Yeah.
The big commentary was fundamentally incorrect. The one takeaway was this, that high credit score borrowers were subsidizing lower credit score borrowers, and that's just absolutely not true. And I don't know what world that exists in, but at the end of the day, the upfront fees and the GSE pricing is risk-based, and it is a risk-based system, and that's what it's been and that's what it's going to be. So I do think that there was a fundamental understanding, because I don't think that people took into consideration the cost of mortgage insurance.
Yep.
The other thing I'd say is, when you look at today's housing market, the affordability issue is very acute. Home prices are really high, and when you look at the supply issue, there's just not a lot there. And when you think about, even in Washington, D.C., you look at, let's say, an average home price was $250,000. One of the things that we are finding is that people think that they need 20% down. 20% of $250,000 is 50 grand. And so when you think about loan to value, understanding that mortgage insurance exists, I think is really critical to today's calculations as you're looking to purchase homes, especially for first-time home buyers. So I think there is fundamental misunderstanding. I think that many people don't speak in the mortgage language.
Yeah.
Most people don't know what an LLPA is, or a DTI, or LTV. And so translating mortgage speak to language that people that aren't in this business can understand is a big part of what we need to do. And people need to understand, one, you don't have to have 20% down. Two, the pricing is risk-based. But three, there are no upfront fees for first-time home buyers, especially if you meet certain income requirements across the country, even in high-cost areas. And three, that mortgage insurance is there, and they're going to have to pay for it, but that the enterprises are not charging twice
Right.
for that.
Yeah, no, well, you did an excellent job explaining that on Capitol Hill. So,
We have 4 hours, I should have. Right.
well, kudos to you there. So I want to shift to credit scoring.
Sure.
You guys are taking a new approach to credit scoring. Kind of a two-part question, really. First part is, you got the ghost of the legacy of past systems, right? The challenges of the operational complexity and the time it takes. So you could talk about how you're working through that. And then related to that, there have been some news reports recently about potentially increased cost for soft credit pools, tri-merge in 2024. I want to how you're thinking about that in terms of your efforts to lower costs for consumers.
Sure. So we've been undertaking this credit score initiative for many, many years. In fact, I think this was one area where Congress passed legislation to require FHFA to look at updating the credit score model. And you know that FICO, classic FICO, has been around for 28 years or more, and it doesn't take into consideration some of the things that are really important in determining a borrower's ability to repay. For example, some of the newer credit score models take into consideration positive rental payments, or they'll take utility payments and other things that people are paying. So we thought that it was important to have multiple views of a borrower's risk. So we think that the technology is there, and to approve both Vantage Score 4.0 and FICO 10T as the credit score models that will be used going forward was important to us. We think competition is also important. With regard to the second change that we recommended, and that was moving from the tri-merge, where you pull the 3, to bi-merge, which is 2. And certainly that's optional. We are really focused right now on getting the implementation right. For example, we're having lots of listening sessions with stakeholders, around the country, because this is a huge undertaking. And as I said, and have repeated, this is a multi-year undertaking. When you think about just the credit score variable and how it's used throughout the process, and it's not necessarily used at Fannie and Freddie for underwriting, but it is used for gating. So you have to have a minimum threshold of X. And so is it going to be 1 or 2? When you think about pricing, how are you going to incorporate, both credit scores for pricing, for pooling, for investor disclosures, and the like? And those are, things that the enterprises have to consider. We also have to look at all of the stakeholders that are using that variable, and we want to get it right. Our focus is on making sure that we get as much information as we can about the implementation process and how this will be impactful from a cost perspective to just the timing perspective. And again, the timing is important, but getting it right is more important. So we've been working with stakeholders. We've had a number of calls, And there have been thousands of people on these calls, and they provide really good input. So what we're working on right now is acquiring data from both, FICO to 10T data, and then also data from Vantage scores, because people want to figure out how the calibration works in terms of here's what classic FICO is, and here's how the new credit score models will work. And it's really important that people understand how the calibration works so that they can use the information in their process of analyzing mortgage risk. And so we've been working with different types of stakeholders. And again, this is not just something that Fannie and Freddie and lenders are doing. We at FHFA have to update our systems. We're working with FHA, VA, and others to talk through here's what we're doing, because we have the same set of sellers and same set of servicers for the most part. And so this is a very comprehensive undertaking. And again, we really want to be careful. You had mentioned the soft pulls. We're very concerned about gaming. And so again, we want to work through with stakeholders who actually do this to come up with some solutions as we walk through the implementation process. So we go through, underwriting, through investor disclosure, and then you even have to use, or some of the enterprise programs have credit score and some of the loss mitigation tools that are available. So again, it's a comprehensive process. We're taking our time, we're getting input, and for us, it's more important to get it right than to implement it very quickly.
Well, I think that is important. So just while we're on the topic of credit scores and access to credit generally, what else is FHFA doing working with the enterprises in this area besides credit scores?
So we think that sustainable access to credit is really important, and I want to make sure that I make the distinction of sustainable access to credit, because typically when we talk about providing access to credit to underserved communities or low to moderate income borrowers, there's a view that the credit box is expanding. The credit box is not expanding. We certainly learned our lesson from the last crisis that you cannot have borrowers with mortgages they don't understand and cannot afford. That's a lose-lose for everybody in the mortgage ecosystem. The borrower loses. We saw foreclosures at levels we'd never seen before. You've got to move your family out of these homes. Servicers, investors lose. So the point of affordability and sustainability for us work together. So we want to make sure that people have loans they understand, loans they can afford, and that there are processes in place to make sure that people understand what they're getting into, since a home is the largest asset that many people will purchase in their lives.
Yeah,
so we're doing a lot. We are working with the enterprises and the home loan banks. We've got the equitable housing finance plans. One of the positive outcomes from that is just focusing on different communities. We're able to come up with solutions that impact the entire country. And so when we're talking to minority renters, we came up with the solution to incorporate positive rental payments. And so that's something that Fannie had embedded in their underwriting system. Freddie did the same thing. Freddie Mac actually has a positive rental reporting opt-in program for their multifamily business line. So if you get a loan from Freddie Mac, if the borrower wants to opt in, they can certainly do the positive rental report, and there's a discounted fee. And so we learned something about how rental payments were not captured in the credit score because they were an expense and not a debt. And so that's something that just works for everybody. We were able to translate the mortgage documents for understanding and reading purposes into different languages. When we did the Hispanic homeownership journey, we were able to take a look at cash flow underwriting, because not everybody has a 9-to-5 job. And so we're able to figure out how to use technology to look at bank statements. And so there are lots of really good policies and programs that have emanated from these equitable housing finance programs that help every potential borrower and borrower across this country. We've actually increased the use of the special purpose credit programs, and those, again, are programs that Fannie and Freddie have, but other banks, like I know JP Morgan Chase has a special purpose credit program, Bank of America. So not only do they have their own programs, but they can purchase loans from lenders that have special purpose credit programs as well. And so we're looking holistically at lots of different underserved communities. We're looking at tribal communities. Freddie Mac just created a program, Heritage One, that works specifically with and for tribal communities and making sure that they have access, because there's some special challenges there. Freddie Mac just came out with this tool. It's called the Down Payment Assistance Program. You're a first-time buyer, a first-time home buyer, you've got down payment assistance programs across this country. This is kind of a one-stop place for people to say, hey, I'm living in Maryland, and here's what's available in my town or state or other areas, other companies that serve those areas. So there's just a lot that comes out that way. And I mentioned the home loan banks, and certainly there's a lot that the home loan banks and their members do to help support affordable housing. And so there's just a lot of activity going on.
There is, and we're going to come back to the Federal Home Loan Banks. So, but housing supply, that's one of the biggest headwinds we face, right? Dr. Brainerd talked about it earlier this morning. What can and is FHFA and the enterprises are you doing to address this issue? And I know this is important to you because I remember hearing you mention it at one of your first meetings with us when you started your tenure.
So the enterprises in particular are secondary market participants. They purchase loans that are made by primary participants. So we're not here to supplant, we're here to support. We're not here to replace any primary market activities. Plus, by charter, the enterprises have to buy loans on properties that exist. So we get the question all the time about construction lending. And so the property doesn't exist and the loan has to be on the property. It's a charter issue. And so we have tried to come up with programs to accommodate, like construction to permanent lending, by having like a single loan at the end of the construction and the purchase period, so that the enterprises can buy the loan that's on a property. And so there's not a whole lot that we can do on the single family space, just in terms of being a direct participant, because we purchase the loans. We have expanded some of the policies for different property types. Like we've been looking at manufactured housing and looking at appraisals associated with manufactured housing, and how can we figure out ways to make that an easier property type to buy. We've looked at accessory dwelling units, the ADUs, and we've changed and updated the selling and servicing guides to accommodate more purchases of those types of loans. On the multifamily side, though, we do have the ability to directly impact supply. The enterprises have multifamily caps, and this year they're $70 billion each. And again, half of those, the $70 billion has to be affordable. But we also have LIHTC programs, and we have allowed the enterprises to invest $850 million each in LIHTC activities across the country. And then half of the LIHTC investments have to be in areas that impact our duty to serve locations, like in rural areas. It could be for manufactured housing or affordable housing preservation. So we've been really looking at ways to try to be helpful in the supply space, and we certainly have been engaged with a number of home builders. We went to, I went to Burleson, Texas a couple weeks ago, went to a manufactured housing site. And I also went to the factory and actually saw one built, and we were talking about some of the challenges and looking at the guide requirements and trying to figure out where we can be more flexible, or are there things that we can do to be more helpful in facilitating the purchase of these types of loans.
Yeah, excellent. So we only have a couple of minutes left. There are two things I want to touch on. Federal Home Loan Banks you mentioned, right? Comprehensive review, two-part question. What are you thinking of in terms of regulatory, legislative, and actions the Federal Home Loan Banks can take themselves? That's part one. Like what should we be thinking about doing to make the system more effective? And then I have to ask about expansion of membership and potentially looking at independent mortgage bankers. That was not in the report, but I would like to get any thoughts you're willing to share on that subject.
Sure. So with regard to the Home Loan Bank report, it was really a very intense undertaking. In fact, the home loan banks turned, 90 last year, and I spent much of my time on work associated with the enterprises, and maybe 10, 15% of my time spent on the home loan banks. And I said, I'm really starting to hear a lot about what the home loan banks are doing, why are they doing it, are they being effective? And I don't know that I could answer that question without getting, input from lots of different people. So we had 3 listening sessions in Washington, D.C. We had 17 roundtables across the country, and I was really surprised at the number of stakeholders that provided input on this very question. And it was very helpful, not just for me, but for our agency, and I think for the home loan banks as well. In addition, we had the 3 bank failures earlier this year in March, and certainly the home loan banks played a role in the financial sector in those bank failures and closings. And so those, taking a look back at that was also very helpful as well. So I would say this, the report really outlines some of the things that we heard and many of the things that we would want to have the home loan banks undertake going forward. There are a couple things that will require statutory changes. For example, we've recommended that the home loan banks at least double their contribution to the affordable housing program. By statute, they're required to share 10% of their earnings across the system, and we said they could at least double that. And we've got an analysis that'll prove it, and I'd also say, there's a number of things I could say, but I won't. Having said, but the one thing that I do want to say, though, is that they are a reliable and stable source of liquidity. They do that very well. They always have, always will. But they're part of a bigger financial ecosystem. And this is one of the things where FHFA, working with the banks and also the primary federal regulators of some of the members, can really be effective. Because one of the things that we learned during the crisis, during the failures and the Great Recession in 2008, because the same thing happened, is that many members were using the home loan banks as a lender of last resort instead of the discount window, which the Federal Reserve set up for that very purpose. And the home loan banks certainly are really good at, making advances, and they've got, collateral-based advances. And one of the things that we've asked them to do is make sure that the members that are lending, you have collateral, but that's not the point. You have to make sure that the lender is a viable lender, and that to the extent they're having issues, that everybody that's at the table has a seat. So if you've got a troubled institution, the decision is, should that troubled institution get new advances, or should some of the advances be extended? Well, before you make that decision, you have to assess the members' creditworthiness and ability to repay, notwithstanding the fact that they have that collateral. You also have to have conversations with the primary federal regulators. So it's the member, the bank, the PFR, and FHFA sitting at the table. And these things happen all the time. We do work together, but what we found over the weekend was that some of the institutions didn't have their operations available and ready to move collateral from the home loan bank to the discount window. They hadn't tested the lines, they hadn't understood or been able to put forth the lien positions. And it's really important that even if you don't use them, that you have the ability to move the collateral to the extent that you need to. So there are just a number of recommendations that we ourselves can do through a regulatory process, and there are quite a few, maybe I'd say 3 or 4, that will require statute or legislative change.
Any comment on the IMB issue?
I thought we were out of time.
We
No.
are, but I had to get it in.
No. Well, no, the comment is, honestly, even if the FHFA even wanted to do that, Congress has been very clear about defining membership. And the one thing I would say is I would want to make sure that any member would be regulated and have, safety and soundness as a provision in terms of making sure they operate in a safe and sound manner and that they have a mission component.
Well, we would agree with that.
Okay.
Director Thompson, thank you very much.
Thank you.
Please, thank you, Director Thompson. Excellent job, and you're very expansive. Just go over a couple logistical issues for this afternoon. 2 breakout sessions begin at 1:05, so for a few minutes to get to your next session. Unlocking Financial Equity Special Purpose Credit Programs in Focus will be in this room, so if you're interested in that session, you don't need to leave. And the other session, Charting Progress, Innovating the Housing Choice Voucher Program for tomorrow, will be held next door in the Holman Lounge. So enjoy your afternoon.
Thank you.
Thank you, Dr. Thompson. Thank you very much.